Alrighty, patrons, good morning, good morning, good morning. Today is Sunday, March 27, 2022. And today we'll be talking about cash out refinance as a means to, leverage your real estate equity. Now, obviously, I'm now sharing my screen. Okay. Now, obviously, March 2nd, 2022, we dropped the weekly tip for ideal traits of a premium investment asset class. Just to reiterate and recap, the first thing we want obviously is an appreciating asset. Obviously, we want the asset to cash flow. We want to be a hedge against a perceived risk. So protecting you from a perceived risk like a flood, and then it's like a wall to protect you. Of course, the fourth one, which is essentially what we're trying to emphasize today, is the ability to leverage the equity in the asset to acquire other things. So one reason why we focus so much on real estate on the platform is because of this very fourth ability here, how essentially the idea is building wealth in a form such that you're building passive wealth in form of equity as the asset appreciates. And more importantly, you can leverage the equity in the asset without necessarily letting go of the asset to purchase more cash flowing, appreciating, risk hedging, and equity leveraging asset as well. So just like you're building wealth passively that you can leverage to acquire more wealth, essentially. So cash out refinance. So what is cash out refinance specifically? So cash out refinance is the idea of when you take a loan on a property or an asset that you own, and essentially you take the loan and liquefy. You take the loan amount is pretty much covered within your equity in the assets, and essentially liquefy your equity. So when you think about real estate equity is usually thought about within the context of it's frozen, because think about your real estate or your investment asset as a bank. Your equity is your balance in that bank, but typically it's frozen. You can't really do much with it while it's stuck in the asset. But with things like cash out refinance, of course, we've talked about 1031 exchange, as well as home equity loan or HELOCs, which we'll also cover later on in terms of the main differences between those and cash out refinance. But those are all means to leverage that equity. And of course, with 1031 exchange, as we mentioned before, you're actually letting go of the property. But with 1031 exchange, you take the equity in one property, of course, you sell it and let it go, but then you can put it in another property or properties as a way of shuffling around your equity, if you will. It's almost like exchanging your deck of cards, like in a card game. So you treat your investment property as like cards and you can shuffle them. So that's why it's called 1031 exchange. Okay. So now specifically, it was cash out refinance. I'm going to walk you through an example that will explain cash out refinance in detail. Okay. So here, simply put, we have a home. Let's say this is a he or she or patron. So this could be you. Actually, I have some patrons who bought homes in Atlanta. Right, the home is 300 grand. The year is 2022. This year, city's Atlanta. You're buying this home as a primary residence. So 300 grand. You assume a 3% down payment. Right, that's 9,000. So the loan amount is 291. So to get the mortgage, okay, it's simple. And we walked you through last week's post. So last week's post, let's go to it. Perfect. So let's go to last week's post. Actually 2 weeks ago, but basically we walked you through estimating a simple real estate deal. So you're gonna see me come here now. So definitely review this post if you haven't already, but you're gonna see me basically use the same website we use in that. Okay, we assume a 300 grand, right? Home. Let's assume we assume 3% down payment. So that's your loan amount is 291K, which is what we have here, right? Interest rate currently is 4.5. Loan term is 30 years. Property tax, you want to estimate 1%. So property tax would be about 3,000. PMI is 0.5%. Home insurance $1,000 a year for a $30,000 home. That's reasonable. And no HOA, of course. And we want to buy. You just hit calculate. So I got 1929. And that's what we have right here. Okay. Utilities are estimated $350 a month. I live in Atlanta. That's reasonable for a 4-bedroom, 2.5-bath home. Revenue estimated $4,000 a month. Of course, again, going back to the post from 2 weeks ago, you can see how you can estimate revenue for short-term rentals here. But again, I'm just skipping all that because I already know it's going to be about $4,000 a month. And your net cash flow is basically just your revenue, right? Subtract your mortgage, subtract the utilities, boom, boom, boom. Get your net cash flow, then estimate your cash and cash returns. Cash and cash returns, we showed you how to do that in previous post. You pretty much just do your net monthly cash flow annualized, so you multiply by 12 to get the annual amount. And then remember, you have to make sure that you're estimating 25% of your cost basis, so the purchase amount. So you estimate like you're doing a 25% down payment. So even though this was a 3% down payment, you treat this like you were buying it as an investment property. So that'll be a 25% down payment. That's very important. So don't use 3%, use 25%. And 25% is a typical down payment amount for investment properties. It's 20 to 25 is the minimum depending on the bank. Most banks will do 20, but conservatively you estimate 25. Okay, so that puts your cash and cash returns in 27.5%. Now in case two, we have the same situation, but let's say now the value of the home appreciates. So this one, I just said let the home appreciate to 125 grand, and that's not unreasonable. So for instance, if we go to compound interest calculator, we just simply do a $300,000 home, 3 years, because you said 2025. Let's say this interest is going up 12% yearly. So we calculate, you see there's about 421K. So about roughly 12%. So let's see, we do 13%, which is what we've seen so far from 2020, 2021. So again, so yeah, 425 is very much so reasonable. Okay. And then so we assume the mortgage balance drops by, so remember the loan amount, which is the mortgage balance starting the loan, is 291K. We're estimating it drops by 7 or 8K. So it drops to 283 in those 3 years. So that's towards the principal payment. Okay. Then your refi amount, this is how you determine your cash out refi. Your cash out refi is now 75% of the current value of the home, which is 425 grand, minus your outstanding mortgage balance. And that gives you about 35,750. You estimate about $6,000 for closing fees, and then you get 30 grand. And I want to emphasize this. With cash out refinance, because like I just explained to you, you treat your property like a bank and your equities like your balance in the bank. Because you're keeping the bank or keeping the property, right? When you do pull out this equity or liquefy it in the form of cash, it is tax-free because it's not considered income, because it's essentially you're pulling into your balance or your equity in a property in the form of a refinance is considered tax-free and is not considered income. So again, what you reiterate, that's another power of real estate. You can leverage the equity, get cash, and that cash is tax-free for USA, okay? So this money, 30 grand after closing fees, is tax-free. So your new mortgage balance now, your new loan amount will just be that 75% of the 425, right? And similarly, your equity is 25%, right? Because your equity is just going to be your new value minus this, right? Your mortgage balance, which is what you're borrowing now, which is the 75%. Remember, you have to use that to pay off your old balance, and then you take the difference, right? Divided by this, 25%. Okay, so now you have a property with 25% equity. You pulled out 30 grand cash after your closing fees. Your new mortgage balance is 218,750, which is 75% of the value. And again, just to reiterate, your refi amount is tax-free. And you can use this 30 grand for whatever you please. This is why it's a cash out refund and investment property. That's another benefit. Remember, with the 1031 exchange, you take the equity from one when you sell it. You use that. You have to use that equity to buy another property or like properties. But there's no such limitation. You can use the 30 grand for whatever. It doesn't have to be real estate related. That's another great thing about cash out refi, because it's your equity, it's your balance. It's like you're doing a withdrawal from a bank. You have some fees, and then the money is yours to do whatever you please. And your remaining equity is 25%, right? So that's one powerful thing about this. Again, 1031 exchange, it has to be another property or like properties, right? And of course, with 1031 exchange, you're letting go of the property. And also, even though this is tax-free, right? So whenever you do eventually sell the property, if you do choose to sell it, there's also keeping in mind that there's the option of 1031 exchange as well to sell it, and your proceeds or gains will still be tax-free if you 1031 exchange, okay? So now you have this 4-bedroom, 2.5 bath, okay? Now, what's your new mortgage? So we just go back to what we know. 318,750 is the new balance, right? So we go back to the mortgage calculator. 218,750. Sorry, actually, let's do it properly. So 425 grand is the new home value. And remember, your down payment, which is essentially your equity in the property, is 25%. So that's why your loan amount is 318,750. Now, the interest rate we used before, when we're buying it as a primary, was 4.5. Remember, keep in mind, when you're now refinancing, you're refinancing this as an investment property. So we assume within those 3 years, he or she, the owner, moves and goes to house hack, another property. So it turns this one to an investment property. So when you're refinancing this, you're refinancing this as an investment property. So now in the USA, most investment property interest rates go up by 1%. So rather than 4.5, now it'll be 5.5. Right, so we're just going to estimate that 2 years from now, the interest rates are the same, just because I don't know the future. So it's an assumption we'll make. Of course, going back by 1% for the property tax does not make our new property tax go up to 4,250. There's no PMI now because essentially once you cross 20% equity in the property, PMI drops off. Remember, in the previous situation, she only had 3% equity. In this case now, because of the appreciation in value, which is yours to keep, you have 25% equity. So no PMI, home insurance, let's just say goes up to 1,400 because the value of the home is appreciated. It's a conventional loan, no HOA, it's a refi. We hit calculate. And you see this is about 2280, 2273. Yeah, it's the same thing. Or actually, was it 1,300 that we did? Yeah, so we said 1,300 in home insurance, so 2272. That's how we get 2273. Okay, cool. So now your utilities. So now we're just gonna make quick assumptions here. So now I'm gonna do something first. We're gonna do first. Let's call this first thing is the worst case scenario, right? Let's say your mortgage now is 2273. So your mortgage has gone up $244 because you just do 2273 minus your previous mortgage, which is 1929. So $344. Utilities, let's say utilities go up $50. Utilities won't change much in those 3 years, $400. And your revenue is 4,000. Let's say your revenue stays constant. Does not increase with cost of living, it just stays constant. Your net monthly cash flow is now $1,327. Obviously, it drops by $394, which is accounted for a year. And so still, even with this, right, your cash on cash returns is still 21%. And remember, in general, first of all, your cash on cash return should never drop below 15%. And ideally, you want to be 18% and above. And this is 21%, so it's well above 18%. So yeah, this is still a good cash flowing property, but now you have 30 grand that you're able to pull out from your equity tax-free. So that's an example of how refinancing can be a powerful tool to pull out some of your equity as your property appreciates over time. As some of you guys have seen, if you've owned property prior to 2020, you've probably gotten some very nice appreciation or equity property that you've owned since. And you can use cash out refinance as a way to pull out the equity tax-free, once again, to do whatever. You can use this 30 grand and use it to get another real estate deal that is another cash flowing asset for you. That's a very simple way people use wealth in real estate to build wealth, because you're just refinancing and pulling out equity that you grow passively for doing nothing, just the nature of the market. And you leverage that to get more assets so you can just keep compounding and growing your equity. Now, so this is the first scenario, but a more realistic scenario, of course, like as you can see, like most of you, for instance, if you're renting, you know, like you rent a place for $1,000, then your rent goes up $80. So that's right there is an 8% increase in revenue for the apartment. And so in a more realistic scenario, so let's say we have $4,000 right now as our revenue, and let's just say our revenue just grows conservatively 5% each year. And we'll see now that our revenue be about 4,600 bucks. So that's a more realistic scenario. So let's say your revenue goes to 4,600. Now I'm doing this because I want to just emphasize as well the importance of investing in places like Atlanta that are growing real estate markets where cost of living is appreciating. And that's why I want to be on the ownership side, because this is actually a good thing for you as a real estate property owner. So with that appreciation, 4,600, you actually see that by doing your due diligence to actually invest in a growing city real estate wise, your revenue actually in most times, in most cases, capture the difference you see or increase in costs from the refinance. So in this case, our revenue has grown 600 bucks. Our costs have only grown 394. So actually our net cash flow going back compared to 3 years ago, which was case one, when you bought the property, has actually grown by $206. So in this case, your cash on cash returns is actually increased to 31%. I also want to say something. When you're doing your cash on cash returns, the reason why we're still using the same cost basis is because even though you're refinancing and your property value has gone up, your cost basis is still what you purchased it for, 300K. So that's why we're still using the same 25%, assuming the 25% down payment if you bought this as an investment property originally, and then your cost basis remains the same again, once again, which is the purchase value at the time when you bought the property, which is 300K. So then going back to what we were saying is in this case, despite the refinance, despite getting 30 grand that you used to go buy another property, cash flow is maintained, cash on cash returns has actually increased because cost of living is increased. And that's why I love short-term rental, because your pricing is dynamic. So each year, so for instance, me and my property manager, we meet quarterly to discuss pricing and see how we're making sure we're tracking and capturing the cost of living increase in the area in Charlotte where we own the property. So yeah, so again, that just walks you through a refinance and how you can essentially, this is in this case, he or she can pull out 30 grand tax-free money to go buy another property or essentially do whatever, even if it means go to Aruba and just have the time of their lives, but still their cash on cash returns increases. So now going back to 1031 exchange versus cash out refinance versus home equity loan or home equity refinance or HELOC. Again, 1031 exchange is very unique from them. It's you're actually letting go of the property. So we'll talk about shortly when to let go of the property. Actually, we can talk about it right now, actually. So when to let go. So remember I said you want 15% minimum, but ideally above 18%. So essentially, if in a case where maybe the market was declining and rather than rent increasing or staying constant, rent actually goes down. So let's say something happens and the rent you can only pull now is 3,300, is an underperforming property. So in a case like this where your rent is 3,300, so your revenue has gone down 700. So now your net cash flow is 627 versus 1721 where you first started. So it's gone down by almost 1,095. So using the same cost basis, which is when you purchased the home, you see that your cash to cash returns is about 10%. So in a case like this, rather than trying to refinance to pull out this equity and then keeping the property and getting this cash flow, you could probably tell yourself like, hey, maybe I should shuffle my deck. Maybe I should exchange this property because it's underperforming. So what you do is rather than refinance, you actually pull in some equity, so 300K. So in a case like this, you could just sell the entire property. So the property was valued at 425, for instance, and your mortgage balance is 283. Your total equity you can pull out will be 425 minus 283, right? And if you do a 1031 exchange, right, you're not going to pay taxes. So you just only pay the realtor fees and some other closing costs. So like you get like 93% of that amount. So the value of the home minus your mortgage balance and then 93% of that. So you stand to earn about, yeah, comfortably in this case, 132 grand. So rather than trying to just like do a refi for 30 grand to pull out some equity, just sell it, capture all the equity, which is 93%, you're not paying taxes. And then you use this money. Remember, you have 45 days to identify a property or properties, and then another 135 days, so 180 days total to close on one or several of those properties identified in the first 45 days. So in this case, you can take this 132 and yeah, you can low-key split this 2 ways and go get 2 properties with it. So 66 grand each. Yeah, so you can use it as down payment, 66 grand each on 2 properties. And actually, to get an idea as well, down payment is roughly 20%. So essentially, you can use that 66 grand as 2 down payments on 2 properties worth 330 grand each, basically. So again, just going back to what we originally had. Yeah, so this is a way how somebody, again, going back to building wealth with real estate, somebody was successfully has flipped 9 grand as down payment, which is the original investment, to 132 grand, which they walk out of as closing equity that it can use to go buy 2 other properties, 66 grand down payments on 330 grand properties, right? Not to mention that there's also, they enjoyed a monthly net cash flow about $1,700 for the whole 3 years. Building wealth of real estate, guys, major hack. So again, going back to this example, so yeah, you can just 1031 exchange it, take this 132 grand and go buy 2 better performing properties that will give you better cash on cash returns than this, and ideally at least 18%. So again, just to reiterate, if you're doing this number, and then let's just put this back to where it was, which was 4,600. Even doing this number and you see that your cash on cash returns dips below 18%, 1031 exchange, so walking out with all your equity, is a valid thing to consider. But then, of course, you're letting go of the property and ideally acquiring better ones. Now, in the case of cash out refi versus home equity loan, cash out refi, like we showed, is up to 75% because it's an investment property. Most banks want you to have at least 20% equity. So they'll do a buffer and actually only give you up to 75% of the value of the home. Home equity loans can go up to 85%. And typically, home equity loans are typically used only for your primary residences. So this is an investment property. So typically, the go-to is cash out refi. For home equity loan, typically, you're using those for primary residences, which is why banks are more willing to go up to 85% of the value of the home, leaving you only 15% equity, because it's not an investment property, it's your primary residence. So they're more willing to do that. So again, just to reiterate, home equity loan refi is up to 85% of the value of the home. Cash out refi is 75%, like we just walked you through. And home equity loan refi is typically on your primary residence. Cash out refi is on an investment property. And also, home equity loan refi is also tax-free. 1031 exchange, the capital gains are also tax-free. So these are all tax-free ways to leverage your equity, which is super powerful. And yeah, and also there's HELOC as well. HELOC is pretty much, rather than actually putting it as a loan in your mortgage, HELOC, they'll actually give it to you as a line of credit, just like a credit card, if you will. So if maybe you only wanted to pull out like 5 grand, something, a small amount from your, those are quick to set up. The banks will typically set that up for you relatively easily, and they'll give you like an interest rate, like a typical credit card. And it's like, but you treat it like a credit card. The idea is you paid up, like you have like your monthly payments and you paid up like a credit card. So those are typically for like smaller expenses. Like let's say maybe you want to do like a really small kitchen remodeling, and you want to just use the equity you have in your primary residence to handle the remodeling, and you take out that equity in form of a line of credit. And that's what a HELOC is for. So they don't do nothing really with your mortgage balance. They just establish a line of credit for you based on the equity in your home. So with that, yeah, we're signing out. We've covered what a cash out refi is. We talked about ways to leverage equity with 1031 exchange, cash out refi, home equity loans, or HELOCs. We talked about different situations where you use each, and we leverage things that we've learned in the past, like cash and cash returns, estimating mortgage, like we've shown you, cash flow, estimating cash flow from STRs, and so on. Yeah, so yeah, signing out. Y'all have a blessed day. Take care.